Hello folks, Steve Lentz here with Discover Options. Welcome to this presentation of advanced options trading reports for the S&P 500. This is for Friday ending January 5th, getting ready for the open on January 8th, 2018. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So before we get to these, I want to make sure you know that you can get a free ebook on options trading called Simple Steps to Options Trading Success. Just click the link, give us your information, we'll get that out to you. Also, if you could please subscribe, that way you will get an alert whenever we come out with new videos on this channel. Okay, so we have three reports, of course. These are all three for the S&P 500. We have the Condor Butterfly Timing Report. For those of you that trade condors and butterflies, answering the question, is now a good time to put on a condor or butterfly and begin a campaign? Okay, the second report is for those that like to sell put options, ideally a standard deviation out of the money, 30 days out, something like that, using a bull put spread or naked puts. And this report answers the question, is now a good time to do that in the S&Ps? Finally, we have the Directional Likelihood Report, looking at the current market condition and answering the question based upon past incidences of our current market condition. What's the market likely to do? Go up, down, wobble around for a bit. Okay, so with that in mind, let's take a look at what the current market condition is. And you can see here that we have described in three different dimensions: price action, trend, and then the stochastic situation. In terms of price action, we have had two consecutive upswing bars, higher highs, higher lows. This is all happening above the 50-day simple moving average, and the 15-3 stochastic is in overbought territory. This is a very common market condition. Not too much unique about this. Over 500 occurrences in total, roughly 280 some odd non-consecutive occurrences. And so a huge population to look at in this regard. Let's go to the first report. This is for those that trade condors and butterflies. Here's the report here. Since January of 2000, we've had roughly 4,550 closes of the SPX. Of those 4,550, almost two-thirds, 65.4%, have been favorable bars for selling premium, where the actual subsequent bar movement in the market was less than what was being implied by the S&P 500 option prices, the SIBO skew adjusted VIX. Okay, so once again, keep that in mind. Two-thirds of the bars turn out to be positive or favorable ones for selling premium through condors and butterflies. We define favorable, meaning that the market doesn't move as much as what is being implied by the option prices. All right, now, during that time, our current market condition occurred 507 times. That includes the consecutive ones as well. Now, of these occurrences, 71.9% were similarly favorable for premium selling, like what I just mentioned. Now, 71.9 is higher than the 65.4, so there's a selling edge here theoretically of about 6.2%. So statistically, it's more likely than usual, okay, based upon the past occurrences of our current market condition, that this condition will end up being a favorable one for premium selling through neutral strategies like condors and butterflies. Okay, all right, so that's it with the condor butterfly. Let's now talk about the bull put spread timing report. Again, the premise is you're going to sell put premium a standard deviation out 30 days away, something like that. And we've had, as I mentioned, those 4,550 occurrences. Now, of those in the S&P since Jan of 2000, 83.3% have been favorable bars for selling that kind of put premium 30 days out, a standard deviation away, where the actual 21 bar downside movement was less than what the option premium was implying, the SIBO skew adjusted VIX. Okay, so that's the benchmark, 83.3. All right, the market did not move down that far 83.3% of the time. Flip a coin, pick a bar, you'll have an 83.3% chance of picking a bar that is where you can sell that premium down there and the market will not hit it. Now, again, our current condition occurred 507 times. Of those 507, 86.6% of the bars were similarly favorable. That's higher than the benchmark of 83.3. That implies a put-selling edge of 3.3%. Okay, so statistically, it's more likely than usual, okay, based upon the past, all right, that the current market condition will end up being a favorable one, more likely than normal, that it'll be a favorable one for selling out of the money put premium. Okie dokie. Finally, the market likelihood report. And what we do here is we're answering the question based upon our current market condition and the past occurrences of it. What is the market likely to do? Go up, down, wobble around for a bit. And to answer that question, we use what I call distribution bands. Okay, now let's take a look at what those are, then we'll come back to this report here. We take the bands that are set apart from the close to the upside and the downside, a standard deviation away, and we just ask the question in the course of the next 5 days in this case, is the market going to go up and hit the upper band, the lower band, or wobble around a bit? And we just take note of that for that particular close. Okay, now notice that the upper band is a little bit closer than the downside band, and that's because in the VIX, in the S&P 500 options, the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. Okay, and so we keep track of every one of these closes. What did the market do in the subsequent 5 days? Did it hit the upper band, the lower band, or wobble around for a bit over the next 5 days? And we not only do this for this 5 day band, but we also look at the bands that go out 10 days and also 15 days. There. And we keep track of statistics for all three bands. So when we go back to this report and look at the top, we can see that over the 4,550 occurrences, the upper 5 day band was struck 21.6% of the time. The upper 10-day band, 16%. The upper 15.2%. The upper 5-day band, 16.3%, 16.5%. The lower 15, 19.3%. So we have 6 bands that we're tracking here to see how often they get struck. And this is the benchmark here. Out of the 4,550, these are the percentages historically since Jan of 2000. Now, our current market condition has occurred 281 non-consecutive times. Okay, I'm only looking at the non-consecutive times here. And of those 281, the upper band was struck 9.3% of the time. That's a big difference, okay, from the benchmark of 21.6. It's a huge difference. It's not even getting hit 10% of the time. Okay, the upper 10-day band was struck 8.9%, again, much less than the benchmark. The upper 15, just 10% of the time, much less than the benchmark. So in all 3 cases with the upper bands, all right, they were struck far less often after our current market condition has occurred. Now let's go to the lower bands. Same situation. All 3 bands were struck less often, although not quite to the degree that the upper bands were. So if you had to weigh it, you would weigh it slightly to the bearish side. But all in all, this is a picture of lower market volatility than normal. Okay, now these bands are being determined by the skew-adjusted VIX. I just want to make sure that that's clear. Now, what I like to do is to carve this up a bit so that when Monday comes, the market opens and it either goes up above Friday's high or goes down below Friday's low. We'll have a picture of the distribution in each of those 2 scenarios. So in the cases where the market goes above Friday's high, that's of these 281, it occurred roughly 177 times that the market went up above Friday's high. Of those 177, all three of the upper bands were struck less often, all right, to a strong degree. Two of the three lower bands were struck less often. The lower 15 was struck actually just a little bit more. But again, 5 of the 6 struck less often. Again, a picture of lower market volatility if the market goes above the high of Friday. Now, if it goes below the low of Friday, all 6 bands were struck less often, as you can see here. And so all in all, we have a picture of lower market volatility, whichever direction the market goes on Monday. All right, and we're seeing an edge in both the Condor and the bull put spread reports. Thanks a lot for joining us. I'm Steve Lentz with Discover Options. We'll be back next week. Have a great week trading. Happy New Year, everyone. Take care.